As I said, we are learning about merchandising this week. We've gone through the accounting cycle already, right? We went through the 9 required steps. You've learned how to take your transactions, post them to the journal, post them to the ledger, trial balances, financial statements, closing entries. You've learned all of that process, right? Now, every week, it's going to be something specific. We're going to address a specific aspect of financial accounting. And this week, it's going to be, how do you do accounting for merchandising companies? And again, merchandisers are retailers. They're companies that don't make products, they sell somebody else's products. So when you go into Target or Best Buy or any retail store, you're buying finished goods that they probably didn't make. Now, a lot of retailers do have their own store brands, right? Like Target has Up and Up, Walmart has Great Value, Safeway has Select. But you know what? They don't make those products either. They put their brand on there, but they pay another company to actually make the product. So merchandisers are selling products that other companies made in almost all cases. I guess the exception, sometimes you'll go to like an outlet store where they're actually the manufacturer and the retailer. But most retail, it's finished goods that somebody else made. So the way we do the accounting in that case is different. You know, since they're not the manufacturer, they don't have to worry about keeping track of all the manufacturing costs, but they do have to keep track of the cost of the goods that they bought so that they know what expenses they have when they sell them. That's what we're going to be learning about. It sounds kind of easy, but I will tell you this is a tough chapter because there are 2 different ways to track your inventory, periodic and perpetual. And you know how it's sometimes tricky to remember which account names to use in a journal entry? Like, which account do I debit? Which account do I credit? Well, that's especially true in this chapter because the answer to that question might be different depending on which inventory approach you're using. Are you using perpetual or periodic? Because they have different accounts. And it also makes a difference if you're the buyer or the seller. Because if your company buys finished goods and then sells those finished goods, you're acting both as a buyer and a seller, and those journal entries are also going to be different. Okay, so that makes this a little tricky. I definitely recommend taking good notes. And I'll show you where in the textbook and in this PowerPoint, there are some sort of cheat sheets that'll help you so that you don't have to remember it all and you can look it up when you get confused. But it is going to be a lot to get through today and Wednesday. I can tell you that. All right. So we'll learn how doing accounting for merchandising companies differs from doing accounting for service companies. Service companies provide a service. They also are not manufacturers, but they don't sell goods. They provide a service. So you'll see how that's even simpler. If you think about the difficulty of keeping track of costs, it's hardest for manufacturing companies to keep track of their costs. It's easier for merchandisers, and it's even easier for service companies in general. Because service companies don't have to keep track of products at all. Merchandisers don't have to keep track of manufacturing. Manufacturing companies have to keep track of all of that. Again, we have the perpetual and the periodic inventory systems. We'll learn what those are. We'll learn how to record transactions for purchases, but also for sales. Because again, merchandisers do both, right? They buy the goods and then they sell the goods. Then we will talk about shipping. Shipping is also freight. right? Freight is just another word for things that are being shipped, like cargo. And we'll learn how to keep track of the shipping costs. Sometimes it's the shipper that has to journalize that. Sometimes it's the buyer that has to journalize the shipping costs. We are also, as if that weren't enough to learn, we're going to learn the multi-step income statement. We've seen income statements, right? What's the basic formula for an income statement? We start with, yes, and the gross income is the revenue, right? So the revenue minus the expenses gets you your net income. That is correct. In a multi-step income statement, it's the same basic formula, but there's just more detail than you'll find in a simple income statement. So you'll see it's very similar to what we've already done, but there are some differences. And then we'll go through transactions for purchases and sales using periodic inventory. So for the most part, we'll be talking about the perpetual method, which is the one that most companies use, but we will spend some time on the periodic method as well. So you'll learn both. I think periodic is a little bit easier, so we're going to start with the harder one, and then it'll be refreshing, I think, when we get to periodic. All right, stop me if you have questions. Because there is so much to cover this week, I'm going to just keep us moving and make sure we stay on track, but stop me if anything needs clarification. Okay, so here's the difference between service companies and merchandisers. Look at their operating cycle. That is the process from when they spend money until they earn money. Okay, that's one operating cycle. What difference do you see between the circle on the left and the circle on the right? See merchandise? Okay. Right here, sell merchandise. You didn't see that over here, right? Here you see provide service. And in order to sell merchandise, you have to have something to sell, right? So you have to purchase the inventory so you can sell it. So both of them start with having some available cash. You need to have money that you can use to buy your merchandise or train your employees or whatever to operate. You have to have some money, right? I mean, you could borrow money, but even if you borrow money, then you have cash, right? So you have to have some cash so that you can provide a service for a service company, collect the money that your customers owe you, which we know is accounts receivable. And then you've got more money available and you can repeat the process. You can then take that money you got and provide more services, right? So that's an operating cycle for service companies. And you'll see for merchandisers, it starts the same. You have to have some money, but then you have to buy some inventory. Ooh, I'll tell you a story. My son, super smart. My son he's so much smarter than I am. And his career is off to a great start. But he's a little bored in his career, and he decided he wanted to start his own business. And he tried like starting a business with a friend and a couple of different things, but nothing was quite working out. So he said, you know what? I'm going to be a drop shipper on Amazon. I'm going to buy products that are already made. I'm going to advertise them on Amazon, and then I won't even have the products. When somebody orders it, Amazon's going to send them out for me. So he had to figure out which products made the most sense. He picked two. One was a yoga wheel that you can use for doing yoga. You kind of, you can stretch your back on the yoga wheel. And then another one was an electric scrubbing brush that you can use to clean a bathtub. Both of them are good products. The reason he picked them is both of them sell pretty well on Amazon already, and they have pretty good profit margins. So he did his research, got those two products. He had to order them from suppliers in China. He worked with the suppliers to put his own brand name on there. But he wasn't making the product, right? So he was really a merchandiser. And he ran into a problem with the yoga wheels. Even though he researched it ahead of time and saw that there was no patent protecting this particular design, there is a company claiming that it's their design. So he bought, I don't know exactly how much, I'm thinking thousands of dollars worth of these yoga wheels, but now he can't sell them legally. He risks being sued. So I think he's decided just to scrap them. Ouch. Lesson learned, right? So as smart as he is, he's young. He's not that experienced in business. And it sounded like a good idea, but this is what happens in business, right? You take a risk and sometimes it doesn't work out. So he bought some inventory. Now he's finding he can't sell it, unfortunately. So for merchandisers, there's a cost, right? There's some risk involved in investing into that product. And then you hope you can sell it. And then you collect money from your customers, right? Sometimes your customers pay you right away, but sometimes you have to bill them and wait for payment. But once you get the money, then the cycle continues. You can buy more inventory. So you see these two operating cycles are similar, except a little more complex for merchandisers because they have to buy the inventory and they have to keep track of the costs. Why is that important to keep track of the cost of your inventory? Okay. If you don't know what your costs are, you don't know what your profits are, right? Because again, the income statement is revenue minus expenses. So you need to know what your expenses are. And those expenses reduce your profits. In general, you want bigger profits, right? But the benefit of the expenses is by reducing your profits, that's less income tax your company has to pay. Right? So that's another reason it's important to keep track of the cost of the goods that you sold, because it reduces your income tax liability. Okay. All right, here we see income statements, very simple income statements for a service company. Basically their sales minus their expenses is their income. That's as simple as you can get, right? Usually they're going to have a little bit more detail of what were their different expenses, but just for simplicity's sake, that is the simplest you could get. For a merchandising company, the simplest income statement would be net sales. We'll talk about what that means in a moment, minus the cost of the goods that they sold. That's the cost of the merchandise that they bought and resold. That gives them what's called your gross margin. Sometimes it's referred to as gross profit margin, but it's the same thing. Then when you take out the other expenses that were not from your inventory, you get your net income or net loss. Now, net sales. What's the difference between gross and net?
Like if somebody were to return something, that would be a net sales.
Yeah, both of those statements are true. If you think about your paycheck, your gross pay is the amount that you earned. Your net pay is how much you get after taxes and other deductions come out, right? And in terms of an income statement, your gross revenue is how much you sold. Your net revenue or net sales, same thing, is how much you sold minus how much customers returned or discounts that you gave to customers, okay? Because you have to keep track of that as well. So on this simple income statement, you don't see that breakdown. You don't see the gross sales or the returns or the discounts. But in a multi-step income statement that we'll get to later, you see all those details. All right, questions so far? Okay, well, journal entries. So here we have a nice, easy example. Clothing store pays a jeans manufacturer cash. This is how you would journalize that transaction. Remember, the merchandiser or the retailer is both a buyer and a seller. In this case, they are buying some inventory. So they have merchandise inventory. What type of account would that be? Yeah, it's an asset. It's something that they now own. And so they debit that asset because they have the inventory, and they credit cash because they paid cash, right? So they have less cash. Pretty simple transaction. Now, again, this is assuming we're using the perpetual inventory method. It doesn't say that up there, but just keep in mind, almost everything we're going to talk about today is going to relate to the perpetual inventory method, okay? We'll get into periodic later. And I'll explain the difference later. Now, if they made the same purchase where they bought some inventory, but they didn't pay for it yet, then they have an account payable, right? We know that that's a liability, so it goes up with the credit. So we see that their liability has gone up the exact same amount that they bought, right? They bought $1,250 of inventory, and that's how much they owe the supplier. So far, pretty simple, right? Excuse me. This is what I was mentioning earlier. I was mentioning it in terms of sales. You take your gross sales minus discounts, returns, and allowances, and then you get your net sales, right? Well, the same concept applies to purchases. The total amount that the company purchased is their gross purchases, minus any discounts that they got, minus any money they got back from returning products, and then minus any money they got back from allowances. An allowance is not what your parents give you for, buying something at the store. In this case, right? In accounting, everything has a different meaning. An allowance is when a customer is not happy and you let them keep what they bought, but you either give them money back or you reduce how much they owe you. So in this case, some of what the company purchased, it wasn't happy with, and so the seller gave them an allowance. It either reduced how much was owed or gave them some money back. But they didn't have to return the item.
What's an example?
Well, we'll see a lot of examples. For example, we'll see one where it says the retailer bought some lights, and some of the lights were the wrong color, they didn't work. So they call up the supplier and say, hey, these are broken, or you sent us the wrong kind. And the supplier says, okay, you know what, go ahead and keep it or throw it away, do whatever you want. You don't have to send it back to us. We're just going to give you some money back or reduce how much you owe us. That would be an allowance. If the supplier says, send it back to us and then we'll give you your money back, that's a return. Okay, so those two are pretty similar. The difference is if the product actually got returned, it's a return. The product did not get returned, it's an allowance. Okay? Good question. Thank you, Maya. So again, starting with the gross purchases, once you take out the discounts, returns, and allowances, you get to your net purchases, right? So that'll be a formula we'll have to refer back to later. All right, let's go forward here. Purchase discounts. Now, that has a specific meaning in accounting. When we talk about a purchase discount, it means that the buyer received a discount because they paid within a certain time period. Okay? That's really the only meaning of purchase discount. Here I'm going to introduce a new concept. These are the credit terms. Now, the numbers that you see in the credit terms vary because they're dictated by the seller and accepted by the buyer. So the two parties have to agree, they have to agree on what those credit terms are. In this example, the credit terms are 210 net 30. The N stands for net. So 210 net 30. Who can tell me what that means? 210 net 30. But yeah, that's exactly right, Yannette. The buyer gets a 2% discount. The first number is the percentage of discount you get if they pay within 10 days of the invoice. And then if they don't meet that deadline, that's okay. They won't get the discount, but the net, the total amount that's due, is due within 30 days of the invoice. So you would read it 210 net 30. Okay. Again, the numbers can change, but the concept, you'll see it's very common in business to have shipping terms or credit terms. Shipping terms too, but we'll get to that later. Okay, so in this case, let's see what happened. The retailer bought some merchandise on September 1st. Now you're gonna find for the whole chapter, the invoice date is always the same as the purchase date. In real life, that's not necessarily true. It could be that the sale is made and the company doesn't generate the invoice for a couple days. But in this case, just to keep it simple, they're always the same date. So the company bought merchandise on September 1st. So they have 10 days to pay for that in order to get the 2% discount. So you just add 10 to 1 and say, okay, then they have until the 11th to get the discount. Now, personally, I would, you could interpret it a different way and say, no, they only have till the 10th because the 1st is the first day. But the way we do it in this textbook, add whatever this number is to the invoice date, and that is the final date that they can pay. So if the invoice date and the purchase date are the 1st, it's 210 net 30, you add the 10, company can pay until the 11th and get the discount. And they did. They paid on the 5th, so they paid within that discount window. Now, the way you figure out the amount of the discount, okay, this is one of those things you might want to write down. You take the amount that is owed, so the company owes $1,600. You multiply that by the percentage, which again was the 2% discount. So the $1,600 that they owe times 2% is $32. Notice that that is a credit to merchandise inventory. That purchase discount that they're getting for paying early is a credit to merchandise inventory. Why would we do it that way? Why would we credit merchandise inventory?
Because you spent less on one account.
Yeah, because that reduced the cost of our inventory. So that asset of merchandise inventory is now going down by $32 because it turned out to not be as expensive as we initially thought, right? Because of that 2% discount. So keep that in mind. When you are journalizing a purchase of inventory using the perpetual method, and there is a discount, it's a credit to merchandise inventory. And I'll show you someplace again that you can, if you forget that, where you can look it up. But then the last step here is you subtract that discount from the amount that was owed. Remember that $1,600 that we multiplied by 2% when we got 32? So now we take 1,600 minus 32 to figure out how much the company has to pay. So you want to solve these sorts of journal entries in that order. Start with how much is owed, multiply by the discount if there is one, and then subtract that discount from the amount owed to get the difference. Okay. Any questions? Okay, great. So here's an example. What if the company did not pay within those 10 days? And this, well, they didn't give us a date. Oh, here, they paid on the 30th. So they missed that deadline by a couple weeks, right? So they don't get the discount. They just have to pay the full amount. That's a pretty simple journal entry, right? They owed $1,600. They've now paid off that liability, so it gets a debit, and their cash gets a credit. Okay. Okay. Trade discounts are really easy. A trade discount occurs when the buyer and the seller negotiate a discount. So it's not because of paying early, it's just maybe the buyer said, hey, we're going to buy 20 units of your product. Can you give us a break? And if the seller agrees to give them a discount, that's called a trade discount. And it's easy from an accounting standpoint because whatever they agreed to, that's what you journalize. So in this case, they agreed on $3,400. So that's how much inventory we purchased, $3,400 worth of inventory. That's how much we owe, $3,400. So anytime you see trade discount, just keep that in mind. From an accounting standpoint, there's nothing fancy you need to do. Just journalize the transaction. Okay? All right, then we get a return. As I mentioned, that's when the company returns a product because there was some issue with it, and they get their money back. Now, the seller could reject it, right? They could say, sorry, it's been too long, or sorry, we disagree. We think the product's not defective, so we're not going to take it back. But usually sellers, they want to keep good relationships with their customers, and so they'll try to honor any reasonable returns. Okay, so if you're the company that made the purchase, like here, we bought some candles. We bought 150 candles, looks like $1 each, so $150 worth of candles. And 100 of them were so badly damaged, we had to return them. Okay, so talk to the company and say, hey, we're returning these candles. And so when we do that, the amount that we owe the company goes down. And if it was $1 per candle and there were 100 candles, that means our account payable goes down $100. But we also have $100 less inventory, right? Because we sent it back. Does that make sense? Okay, I'll take your silence as a yes. And what if the other 50 candles we can sell, but they're not the style that we ordered? We wanted the vanilla scented and they sent us strawberry or whatever. So we call up the company and say, hey, there's a problem with these other candles, but we'll try to sell them anyways. They might say to us, oh, sorry, we goofed up. You don't need to send them back, but we'll go ahead and give you a $20 discount. Well, I shouldn't say discount, $20 allowance. We'll reduce how much you owe by $20. So again, our account payable is going down. And again, we are crediting merchandise inventory, even though we didn't send it back. So once again, why would we credit merchandise inventory?
Because you have to pay less.
Yeah, because the cost of that inventory went down. Even though we still have it, it did reduce our costs. So you see that the journal entry for the return looks exactly the same as the journal entry for the allowance, right? That's nice. It's a complicated enough chapter when something simple like that, it's kind of refreshing. So, any questions at this point? You might be thinking, oh, this isn't that bad. But by the time you leave today, you're going to be thinking, oh, this is bad. Okay, so the same concept that I already talked about, gross sales leading to net sales, it's right here. The total amount a company sold minus any discounts it gave to companies that paid early, minus any returns from when the buyers returned something, minus any allowances from when they gave an allowance, even though the product wasn't returned, equals net sales. Right? And if you remember on the simple income statement, that was all we saw. On the multi-step income statement, we'll see all of those. Right. Okay, so steps in record, God bless you. Steps in recording the sale of merchandise. Okay, so far we've mainly been looking at purchases. Now let's look at how do you journalize a sale. This is probably a good time for me to explain what is meant by perpetual inventory. What does the word perpetual mean?
Always.
Always. Something that's always happening is perpetual. Why do you think there's an inventory method called perpetual inventory? Yeah, because every time we make a sale, we keep track of the cost of that sale. When we get to periodic, it's a little easier because you make a sale and you don't have to worry about the costs. In the periodic method, you figure out the cost of your sales periodically, like once a month, once a quarter, something like that. But with perpetual, it's every time you make a sale, you record the cost. And again, this is the more common method because it gives companies a more accurate view of their profits. If you're recording your costs with every single sale, then you always know what your costs are, right? Instead of having to wait until the end of the period to find out. So most companies do use this perpetual method. The likely exceptions would be small companies, like if you had a small mom and pop shop and it was just too hard to keep track of your costs with every single sale, so maybe once a month you count up your inventory to figure out how much you sold. You know, that would be a logical time to use periodic, but most companies would use perpetual, especially if you have a computerized system that keeps track of your inventory, then you might as well keep track of your costs with every sale. Okay, so these are the steps in recording the sale of merchandise. You record the sale. Remember the revenue recognition principle. When do we count something as a sale? When it happens, when you either provide the product or the service to the customer, that's when it's a sale, right? Doesn't matter if they paid, just the fact that you did it, you took that action, giving them the product or the service, that you have a sale. Right, okay. And with the perpetual method, as I said, we have to keep track of the cost at all times. So every time we have a sale, we have to update our merchandise inventory account and our cost of goods sold account. Have I mentioned to you that inventory is an asset until we sell it? And then it becomes an expense. And that expense is called cost of goods sold. Now you might remember the expense recognition principle. Who remembers what the expense recognition principle tells us? When can we count an expense related to our sales of our products? When we have a sale, right? So at the time we bought the inventory, it was an asset. We could not count it as an expense. only when we sell it can we count it as an expense. And again, the name for that is cost of goods sold. Now, something I have not told you before, when we figure out the cost of the goods that we sold, it's not just what we paid. It's not just the basic cost of the item. It includes any shipping costs, taxes, insurance, stocking fees, and overhead related to the product. So it's the total cost of acquiring those goods. When we sell them, that's what we count as the cost of goods sold. All right, are there any questions? Annette?
For cost of goods sold, let's say if you make a cake,
Okay.
in a bakery, would the ingredients be considered as a chocolate or no?
Yeah,
Yeah.
yeah.
would-
But again, that would be manufacturing, right?
Yeah.
So now you're figuring out the
Oh,
cost of the
right.
goods manufactured.
Okay.
And then not all the things that you manufactured got sold. So in manufacturing, you have both cost of goods manufactured and cost of goods sold, which are separate numbers. Yeah, good point. Right? For a merchandiser, like, let's say they're buying pre-made cakes. So if there's a cake that costs $10, if they're buying it wholesale, they wouldn't have to pay sales tax. Only consumers have to pay sales tax. So they wouldn't have tax in that case, but they might have a shipping cost. If it's an expensive product, there might be insurance on the item. So those would go into the cost of acquiring that item that they resell. All right. Good question. Thank you, Yannette. Okay, so let's see some more journal entries for sales here. And this shoe store is selling these athletic cleats. They sell them for $1,500. It costs the company $900. Now, when you journalize it using the perpetual method, you have to track both the sale and the cost of goods that you sold. So notice this journal entry has 4 accounts. At one time, for one transaction, we're having to journalize 4 different accounts. Now, it's usually going to look like this. That's one nice thing is that when you make a sale using the perpetual method, pretty much always going to be the same. Instead of cash, if the customer hasn't paid, what would we put? Accounts receivable. Okay, so that's a common difference. You might see accounts receivable instead of cash. Instead of sales, you might see sales revenue. You know, but we know that that's the same thing. Just some companies put sales, some people put sales revenue. But these will always be the same: cost of goods sold and merchandise inventory. So let's think about this for a second. We made this sale $1,500, right? $1,500 worth of these athletic cleats. That's revenue. Revenue is not part of deal, so it goes up on the credit side. We got paid cash, which is an asset. That goes up on the debit side, right? So we've made a sale and we got some cash. Then we debit cost of goods sold. What type of account did we say cost of goods sold was?
Expense.
It's an expense, which is part of deal, right? So it increases on the debit side. And then merchandise inventory is an asset. It's going down. So that decrease is on the credit side. If you think about what types of accounts they are, it might help you see why we're debiting in some cases, crediting in others. But that is what your perpetual inventory sale is going to look like. Okay, any questions on that? Okay, sales discount. If we give a discount to a customer for paying early, we don't know for sure that they're going to pay early, right? We give, okay, here are some terms. Again, 210 net 30. So we've told the customer, if you pay within 10 days of the invoice, we're gonna give you a 2% discount. Well, we don't know if they're gonna do that or not. They don't even know. Maybe they plan to, but maybe they missed the deadline. So we have to journalize the entire sale. We don't give them the discount until they pay. And we saw that they did pay within that discount window. So we would journalize like this, saying, okay, our customer owes us $1,000. And we also have to record the cost of the goods, right? That's the other part of the transaction. But then when the customer pays, if they did pay within that discount period, that's when we would then say, okay, they owed us $1,000. 2% of that is $20. So that's the discount we're going to give them. Notice we debit sales discounts. And then how do we figure out the amount of cash that they have to pay? We know it was $1,000 purchase, gave them a $20 discount. Subtract. We multiply to get the amount of the discount, right? But then we subtract that amount from what they owed to get the balance that they have to pay. So remember that, multiply first to get the amount of the discount, but then you subtract it to get the amount they have to pay. If they did not pay in time to get the discount, then they owe us the full $1,000. Right? All right, return. Okay, now this is interesting. Think back to what a sale looked like. In fact, I'm not going to make you do that. I'm going to show you what a sale looked like. Okay, so remember, a sale looks something like this. Either cash or accounts receivable gets a debit, sales or sales revenue gets a credit, then we have cost of goods sold, then we have merchandise inventory, right? Now, if the customer returns an item, it's basically going to be the opposite. Everything gets reversed. Oh, actually, this is the sale. Sorry, I didn't have to go back. This is the sale. So it's the same thing. This is where the customer returns something. So notice that everything flipped around. Now accounts receivable is getting a credit because now the customer doesn't owe us as much. So we had to reduce their account receivable. Also, we got inventory back. So now we debit merchandise inventory because our inventory just went up. And we credit cost of goods sold because now our expenses have gone down because, again, we got the merchandise back. So it's really the opposite of the sale, but with one exception. When the original sale was a credit to sales, the return is a debit to sales, returns, and allowances. We use that account both when there's a return and when there's an allowance. So if we agree to reduce how much a customer owes us for either a return or an allowance, we use the same account. Sales, returns, and allowances. Now we can see here that this is a return because we got inventory back. If it were an allowance, it would not have returned the inventory. So it would only be these two accounts. There'd be no inventory involved. So it's important that you always think about, okay, in this transaction, are we the seller or are we the buyer? That depends on, I mean, that influences how you journalize it. In this case, we're the buyer. And we got inventory back, so we have to then journalize it. Starting to see what I mean about this chapter? It's kind of complex. It's like an onion with many layers. You think, oh, that's not too bad. And then like, oh, there's another layer and there's another one. All right, any questions? Okay, keep going forward then. Okay, so here a customer was dissatisfied with some of the plants. we agreed to give them a sales allowance because we're the seller and we're giving the allowance, it's a sales allowance. Their perspective, in their accounting records, the buyer would put that it's a purchase allowance. But because we're the seller and we're talking about our accounting records, we call it a sales allowance. So again, it depends on whether you're the buyer or whether you're the seller, as far as how you journalize it. Okay, so notice that in this case, oh, they did get returned? Wait a minute. Let me read this because I'm a little confused right now. Let's see. The customer was only dissatisfied with 100 plants. They did return 100 of them for a partial refund. Well, that's weird because here it says sales allowance, but they returned them. So that's a typo. My bad on that one. So it's not an allowance, it is a return in this case because the customer returned it. So again, debit to sales returns and allowances, you reduce how much the customer owes you by crediting their account receivable. We got the inventory back, our cost of goods sold went down. Okay. So I already explained the difference between perpetual and periodic. Which one have we been using so far? Perpetual or periodic? Perpetual. Because every sale we have to record the cost of goods sold. So with perpetual, when you make a purchase of inventory, as we've seen, you debit merchandise inventory. Later, when we start using the periodic method, you'll see that when you make a purchase, you debit purchases. Okay. I can't really tell you why, but that's just the way we do it. Just keep track of that. When you return items, if it's perpetual, we already saw that when you return an item, the cost of your merchandise inventory goes down, so it's a credit to merchandise inventory, right? But with the periodic method, there is a separate account for purchase returns and allowances, and you would credit that account instead of merchandise inventory. Okay, I don't expect you to memorize all of this. I'll show you later where you can find cheat sheets that'll help you, but I do want you to understand what's going on. What if you get a discount because you paid early? Well, those two transactions are almost the same. The difference is under the perpetual system, you reduce your merchandise inventory by the amount of the discount. We saw that earlier. Remember, if it's a 2% discount, you figure out what that 2% is, and then you reduce your merchandise inventory by that amount, right? If you're using the periodic method, they have a separate account, purchase discounts. Okay. If there's a sale, again, with the perpetual method, there are 4 accounts that you need to journalize when you make a sale. But with the periodic, because you're not keeping track of your merchandise and the cost of the goods sold, there are only 2 accounts involved, only the sale and the cash or account receivable. And you don't worry about the inventory until the end of the period. If there's a sales return, same thing. You've got 4 accounts involved here under perpetual, basically the opposite of a sale. When you return an item or when an item is returned. Under periodic, again, if your customer returns some merchandise, you didn't count it when you made the sale, so you don't count it when you do the return. When are you going to count your inventory? At the end of the period, if you're using the periodic method. And then sales returns, I'm sorry, sales allowances. That's right. Yeah, sales allowances are going to be the same under both perpetual and periodic. Okay, that's nice. Something is consistent for once. So in both cases, if you have a sales allowance, it's going to be a debit to sales returns and allowance and a credit to accounts receivable. And that makes sense because in an allowance, there is no inventory involved, right? You're just giving the customer an allowance because they're not happy. So there's no inventory to track. If there is a sales discount that you're giving your customer, why do we give sales discounts? What situation? They paid within the discount window, right? Again, it's going to be the same whether you're using perpetual or periodic. Their account receivable gets paid off. You subtract the amount of the discount, and the difference is what they had to pay. Okay? A lot to remember, so that's why I don't expect you to remember it. But hopefully you at least understand it and know where to look it up, which again, I'll show you a little bit later, so that you can answer all the problems correctly. All right, are there any questions? Other than when's break? Not yet. It's only 2 o'clock. We got some time. Okay, so you might remember last week we learned about the closing process, right? We learned about how to close out our revenue accounts, our expense accounts. Let's think for a second. These accounts like sales discount. What type of account would that be? Is a sales, if we've given a discount to a customer, what type of account is that?
So loss.
Well, a loss is when we sell an asset that's not a product for less than the book value, right? So good guess, but no, not a loss. Like an expense. No, and liability would mean we owed somebody something. So what's a sale? Let's start there. A sale is what? Revenue. So a sales discount is a contra revenue account. It's like accumulated depreciation I mentioned to you is a contra asset because it reduces our assets. A sales discount is a contra revenue account because it reduces our revenue. Right? We sold this much, but then we gave these discounts, and that reduced our sales from gross down to net. Same thing with sales returns and sales allowances. All of them are contra revenue accounts. They reduce our overall revenue. Okay, so, oh yes, so the closing process. That's why I brought that up. Remember in the closing process, you close out your revenue accounts, and then you close out your expense accounts. Remember last week? And then you close out your income summary account, and then you close out your dividend, right? Well, those contra revenue accounts, like sales discount, sales return, sales allowance, we have to close those out too. We would close them out along with the expense accounts because even though they're not expenses, they reduce equity just like expenses do. So we would close those out at the same time we close out our expenses. So, okay. Let's see, a perpetual inventory system. We always know how much inventory we have because every time we make a sale, we keep track of how much inventory we sold. Think about when you're checking out at a cashier or self-checkout stand and you scan your item. That tells the computer system not only what you're buying and how much you owe, it also tells the computer system how much inventory they just sold, right? So it allows them to perpetually keep track of the cost of their sales. If you were using the periodic method, you wouldn't know that, right? Because you'd have to wait till the end of the period to figure out how much inventory you sold. Now, even if you use the perpetual method, we can't trust that the reports that the computer spits out are always 100% accurate. So if the computers are keeping track of what we sold, you would think if at the end of the month you stopped and you counted your inventory, it would match up exactly, but it usually doesn't. Why might the actual inventory that we have be different from what the computer tells us? Why might our cost of goods sold not match what the computer is telling us we sold in inventory? Does inventory sometimes maybe get misplaced or stolen or thrown out or sent back to the manufacturer, whatever, right? So even if you're using the perpetual method, you still need to periodically just double check and make sure that the numbers are right. So even in the perpetual method, you're going to periodically check and count your inventory. There are some companies that use RFID technology. Anybody familiar with that? Radio frequency identification, where every product has a little computer chip that sends out a radio signal to say, here I am, here I am. And so the computer can track the inventory wirelessly in real time and always know exactly how much inventory you have. But I think most companies don't have that sophisticated system in place. So that means every once in a while, they need to count their physical inventory and make sure it matches what the computer says. Okay. Okay, so if, let's say it's the end of the period and you've done that count and you found out there was a difference. In this case, it says inventory is overstated. That means we're missing some inventory. We don't have as much as we thought. So our accounting records maybe say we've got $10,000 of inventory. We only counted 9,000. In that case, that missing inventory increases our costs. So to correct it, we have to adjust our cost of goods sold and reduce our merchandise inventory. Now our accounting records will match what we actually have in physical inventory. On the other hand, what if it was the other way around? What if we counted more inventory than our computer records? So maybe again, our computer says we have $10,000 worth of inventory. We counted $11,000 worth of actual inventory. What would that journal entry look like? The opposite. Exactly. In that case, we would reduce our cost of goods sold by crediting, and we would increase our merchandise inventory by debiting. And then our, accounting records would match the actual physical inventory. Okay, in the closing process, remember we close out our revenue to income summary, then we close out our expenses like cost of goods sold to income summary, that's step 2. So what you see here in that second step of the closing process, we're also closing out the contra revenue accounts, sales discounts, and sales returns and allowances. So those get closed out in step 2 together with our expenses. Okay. Oh, now we're talking about periodic. Okay, let me see what questions do y'all have. Anything unclear, confusing? All right, well, so with the periodic system, again, called that because you don't keep track of your cost with every sale. You don't keep track of your inventory with every sale. You keep track of it periodically, right? So then how would you figure out the cost of goods sold for that period? Well, we have a formula for that. You would look at how much inventory you had at the beginning of the period. You would add your net purchases and then subtract the inventory you had at the end of the period. Remember net purchases? It was the gross purchases, everything we purchased, minus what? Any purchase discounts, purchase returns, and allowances, right? Which we see here. Net purchases equals gross purchases minus purchase discounts and purchase returns and allowances. So this formula gives us this, which is part of this formula to get cost of goods sold. Okay, any questions? Right. So here's a table. I don't think we really want to go through the whole table here, but this is a helpful reference. This is one thing you could look at if you have questions and say, okay, well, how do we do this? So in this column, we've got perpetual. In this column, we've got periodic. And you can see that when we're purchasing, so when we as a merchandiser are buying inventory, right? Under perpetual, notice it's the merchandise inventory account that we use. But when we're using the periodic method, it's the purchases account or purchase returns and allowances or purchase discounts. So with perpetual, it's merchandise inventory, periodic purchases. That's a fundamental difference between the two techniques. With selling, when we are the seller, we're going to have 4 accounts when we record a sale under the perpetual method and 4 accounts when we record a return. Because remember, we're keeping track of both the sale and the inventory. But in the periodic system, it's simpler. We don't have to worry about the inventory, so there are 2 accounts for the sale and 2 accounts when we do the return. And then with the sales allowances and sales discounts, it's the same whether we're using perpetual or periodic, okay? So this table might be just a helpful general reference, but I'll show you, I guess it's gonna be a little while, but we will get to some really useful charts. There are 4 charts that we will see. 2 are for perpetual, 2 are for periodic. In each case, you've got 1 for sales and 1 for purchases. So you can look at the appropriate chart and saying, okay, this is perpetual, this is a sale, what do we do in this situation? And it tells you exactly what account to debit, what account to credit. Okay, so again, you're not gonna have to memorize that. You'll just have to know where to look it up. All right, here's a hypothetical situation. This company is using the perpetual inventory method. They do a physical count every 6 months to make sure that their accounting records are accurate. Even though they record the cost of goods sold and the inventory with every sale, they check every 6 months. Now, an employee notices that there are a lot of missing and damaged units. In fact, the inventory is supposed to be $300,000, but when they do a physical count, it's only $200,000. They're off by $100,000 in terms of how much inventory they have because of missing and damaged inventory. What would you do in that case? If every 6 months you're finding you're off by $100,000 of inventory, how would you fix that?
Check more often.
Okay, excellent idea. Check more often, maybe check every month. Now, it takes time. You have to pay your workers to go out there and count all the inventory, right? So it's kind of a hassle, but that might help you identify what's going on. What else could you do? In addition to Julian's suggestion, what else could you do to help reduce the missing or damaged merchandise? Maybe when you receive it, make sure you got exactly what you'd ordered, right? Because if you don't open up the box to inspect it, the box might be half empty. How do you know, right? So and that's what companies do. They have a receiving department usually that opens up any deliveries to check and make sure that what's in there is what's supposed to be in there and that it's not damaged. How about if your stuff is just disappearing? Cameras. Maybe put cameras, right? Even if the camera is not real, even if it's a fake camera, it's probably going to deter thefts because people will be like, oh, there's a camera. I better not steal that inventory. So these are some of the things you might think about doing, right? Okay. Okay, so here is an example. This is Perpetual. And this company sells packages of computer hardware. So a package includes a desktop computer, a tablet, a landline phone. You all know what that is? The phone that plugs into the wall, basically. Not to charge, but to make a call. And a printer. Okay, so one package includes those four things. Here are the individual prices for those four items that the company charges. Wait a minute. Oh, this is the price that they're paying. Yeah, this is the price that they're paying. Okay. So if they buy 10 of these packages, if you added up these four items, it comes out to $620 for each package. So 620 times 10 is $6,200 of inventory that our company is buying. And here they paid cash, so credit to cash. Okay, pretty simple. Now they make a purchase of 30 computers on credit. So the computers were $400 each. So 30 of those is going to be what? $12,000. So in this case, they bought some more inventory, this time only computers, $12,000. And they owe $12,000. Since we're journalizing the buyer, right? In this case, our company is the buyer. They have an account payable. The seller, if you look in their accounting records, they would have an account receivable, right? They're going to receive the money. But this company has to pay the money. Okay. Now the credit terms are just net 15. They get any discount if they pay early? Not in this case. So they need to pay within 15 days of the invoice. They pay early, great, but they don't get any discount. And they do pay, they pay within the window. So if you don't pay by the due date, typically you don't get a penalty like you would like with a credit card company or something where they'll charge you a fee. That's not typically going to happen. Your supplier is not going to penalize you for paying late. But in the future, they might require that you pay up front. They might not give you any credit at all. Or they might give you a shorter period of time to pay. So that's the incentive to make sure you pay on time. Okay, so what if they make their payment in full? Okay, it looks like this. They paid off their account payable and they used cash. Okay, pretty simple transactions so far. Here they buy a bunch of tablets. And okay, how would we pronounce this? How would we pronounce these credit terms? That is exactly right. You could say it more, briefly. You could just say 5, 10, net 30, but that is what it means. They get a 5% discount if they pay in 10 days from the invoice and the net's due in 30. So 5, 10, net 30. Okay, so here they journalize how much inventory they purchased, how much they owe. Then when they make the payments, notice the account payable that they owed, what is it, $4,020? Goes away with a debit. But did they pay 4,020? No. And why not? They got a discount for paying early, right? Because they paid within 9 days, they get the 5% discount. Well, they had 10 days, but they paid within 9. So 5%, we multiply that by the account payable, and we see that comes out to $201. That is their discount. And we know that in the perpetual method, we would credit merchandise inventory if we're receiving a discount for paying early, right? And then we subtract that amount from accounts payable to figure out how much cash we actually then have to pay. Okay, does that make sense? Right. Okay, if they paid on the 25th, well, we didn't get the discount, we have to pay the full amount, right? So here they're paying the exact same amount as the account payable. Here's another scenario. They buy a bunch of landline phones. I don't know why nobody buys those anymore, right? So they now have some inventory. In this case, they paid cash. Now they find 25 of them are the wrong color, so they return them. Now this is interesting because they paid cash and then they made a return, the supplier has to give them cash back. If they hadn't paid yet and they made a return, the supplier would just reduce how much the company owes. But because they already paid, the supplier then gives them cash back for the phones that they returned. And again, they returned the phones, so their merchandise inventory went down. Okay, then they find 60 phones are slightly damaged and they keep them, but they are given an allowance. Again, they've already paid for the phone. So in this case, the allowance means actually getting some cash back. So notice this transaction looks exactly like the return. In both cases, they got cash and the cost of their merchandise inventory went down, both for the return and for the allowance. Exact same format. Okay. Then they buy some printers. Okay, they got some more inventory. They have some more debt. They find some of the printers are damaged. They return them to get a full refund. So their account payable goes down for those items, right? It was, let's see, at a cost of $100 each, and they returned 15 of them. So 15 times 100 is $1,500. And then that's how much inventory they don't have because they returned it. Okay, then they discover 4 printers are slightly damaged. They get an allowance of $30 each. So again, they didn't return them. We multiply 4 by 30. So their account payable now goes down by $120 because of the allowance. And the cost of their inventory also goes down. Then they pay their account in full. Now, the amount of account payable they have at this point is $6,380. Where did that number come from? We haven't seen that number, right? So what we have to do is go back and look at the original purchase, $8,000. And say, okay, from the return, that went down by 1,500, right? Originally was a credit of 8,000 to accounts payable. Now we have a debit to accounts payable of 1,500. So that reduces the balance in accounts payable from 8,000 down to 6,500. But then we have the allowance. That reduced it by another $120. So now our ending balance in accounts payable is a debit balance of 6,380. That is what has to get paid off. So remember, as you're going through the problems, you have to figure out what is the ending accounts receivable or accounts payable, because it works the same both ways. You have to start with the original amount, subtract any returns, subtract any allowances to get down to the ending amount that's owed. And then the discount is based on that. So now their payment terms were 5/15 net 40. So because they did pay within the 15 days, we take 5% of the final accounts payable to figure out how much of a discount. Okay, so first, figure out your final account payable. If a discount applies, multiply by the percentage, and then subtract. Right? Subtract the amount of the discount from what was owed to see how much has to be paid. Right? Any questions? Okay. Oh, good. So this is one of those 4 charts I told you about. This one is for perpetual. This one is for perpetual. Sorry. Gotta slow down a little bit. It's for perpetual inventory method and for purchases. So if you come across a problem and you don't remember what account to debit and what account to credit, if it's a perpetual inventory example and the company is purchasing, not selling, but purchasing, then you would look at this chart and say, okay, what am I trying to journalize? If it's the original purchase and they paid by cash or they're going to pay later, I can look down and see exactly what account to debit and what account to credit. Makes it nice and easy. What if after the purchase, they're now making a payment? So they didn't pay at the time and they're paying later, right? Well, if they got a discount, we can look here and see what to debit, what to credit. If they didn't get the discount, again, we look at what to debit, what to credit. It tells you. What if we got a purchase return or a purchase allowance? Well, if we've already made the payment, we would go to after payment. If we have not made a payment, it would be before payment. Now you don't have to remember. So if you download this PowerPoint presentation, you'll find 4 of these charts. We'll see the other 3 later. But you can also find them in the textbook. Okay, so this is going to be really helpful as you're going through the problem set. Instead of pulling your hair out, trying to remember or look through your notes, just look it up on the, you have to find the right chart and then find the right place on the chart, but then it tells you exactly what to do. Okay, any questions? All right, well, let's cover a little more. Oh, did I break it? I broke it. I know it's a lot. Let's see. I'm just curious here. Where are we at? We are almost halfway through this chapter, which is good, right? Because we have today and we have Wednesday. So as long as we get past the halfway point today, within the next 10 minutes or so, before we take a break, that means we're making good progress. And we do have 19 exercises and 4 problems. So So the lab period is gonna be kind of intense as well, but we're on track. Oh, good, let's do a little practice. This will be refreshing. Okay, record the journal entries for the following transactions. So you know what I'm gonna do? I'm gonna take this over here and I'm gonna stand over here for a while. We'll go through this together. So you might want to follow along on a piece of paper or on your computer. I'm going to put this in a Word document. And that way it'll be easy for us to go through it together. Okay, let's try that again. There we go. That's one of it. There we go. Okay. Now we can just go through this together and see, and feel free if you want to pull up those charts in the textbook or the PowerPoint for reference, feel free to do that, because we are going to journalize these three transactions. So the first one, the company purchased, and I'm assuming this is perpetual. Let's double check. It doesn't say anytime in the exercise set and the problem set. If it doesn't say, assume it's perpetual, okay? If it's periodic, it will say specifically to use periodic. But in this case, we're doing perpetual. So we're buying inventory on credit. What account will we debit and what account will we credit? Yep, we're going to debit merchandise inventory, and it says it's $500 worth, so it's a debit, $500. And what would we credit if we have not paid yet? Accounts payable. That's correct. So the first transaction is going to look like that. Of course, we would put the date and we would put a note, but that's the basic transaction. Then we are returning $150 of that inventory for a refund. So for that transaction, what are we going to debit? Yep, we're going to debit accounts payable. How much? $150, because that's the amount we return. What are we going to credit? Merchandise inventory, that's right. Right? Because the cost of our inventory just went down by $150 when we returned it. Then we pay in full. Okay, let's look at the dates. So the purchase is December 3rd, and that's the date of the invoice. We make our payment 6 days later on the 9th. The terms were $210 net 30. Did we earn a discount? Yes. And what percentage? 2%, right? So we get that 2% discount. But we have to figure out 2% of what, right? So we have to figure out what is our accounts payable balance at this point. Originally was $500, right? $500 credit. And then we debited accounts payable $150. So what's the remaining balance in our account payable account? $350, right? You take the $500 credit minus $150 debit. That leaves $350 credit in accounts payable. And to clear it out, we have to debit that amount. Okay? Or just the easier way to think about it, 500 minus 150 Leaves us with 350. So we did say we get a 2% discount. So let's take, well, I think that comes out to $7, right? $350 times 2%, $7. Okay, so we're gonna get a $7 discount. What account do we credit for that? Merchandise inventory, right? Because that discount is reducing the cost of our inventory. And what is the last account in this transaction? Where we're making the payment. How do we pay? Cash. Okay. And how do we figure out how much cash we have to pay? We subtract. We take the final accounts payable amount that we owe minus the discount, and we owe the difference. So we pay 343 bucks. So those are our 3 journal entries. Hopefully it makes sense. I know it's a little hard to remember, but again, we could have looked them up if we needed to. Any question on those journal entries? All right, well, let's see what's next here. An exercise, okay. We've got 5 minutes. Let's go ahead and do exercise 8, and we'll take a break. This one is going to be kind of similar to what we just did, I think. Let me make sure. Let's see. Yeah, it's going to be similar. It's perpetual inventory method, and it's purchases. Okay, so this company is buying some lights. These are products that they're planning to resell. And the amount has already been calculated. So we see the total cost of those lights that they purchased. What do we debit and what do we credit for the original purchase, the inventory? I'll give you a hint. We do see that there are payment terms, which means we did not pay cash, because if we paid cash, we wouldn't need any payment terms, right? So that means we have an account payable because we haven't paid yet. What would we debit for the purchase? If we're using the perpetual inventory method, we would debit merchandise inventory. Okay, so that would be the purchase. Then on the 22nd, 100 of the lights are the wrong model, and we're given an allowance of $800. Okay, how would we journalize that allowance? Yep, our accounts payable is going to go down by that $800. And the cost of our inventory also went down, right? So we're also going to credit merchandise inventory. So this is one of those situations where it's basically just the opposite of the previous. Okay, what is the balance in our accounts payable account? We had a credit to accounts payable, then we have a debit. So the remaining balance is this $16,450, right? So that's how much we have to pay off when we make our payment. If we made the purchase on the 20th and we made the payment on the 30th, and the terms were 10/15 net 40, do we get a discount for paying early? We had 10 days, no, we had 15 days to pay, and we paid within 10 days. Right? The 20th to the 30th is 10 days. So that means we get a 10% discount. That's pretty good. So we take the accounts payable that we owe, which is, again, it was the 17,250 minus 800, leaves us with 16,450 of accounts payable. We multiply that by 10% to get our discount, which we know is a reduction of our merchandise inventory. And then we make our payment, and you could take the total amount that we owed minus the discount. The difference is how much we have to pay. What account do we credit? Cash. All right, so that's what this chapter is all about, all right? I think you need a break, so come back in 10 minutes.